In this video, I want to consider low volatility investing, how to build a stable portfolio. So low volatility investing, it's an investment strategy that is focused on uh, selecting stocks or assets that exhibit lower price fluctuations, compared to other stocks in the market compared to the broader market. The primary goal of this approach is to achieve a more stable returns, and reduce the risk of significant losses during market downturn. While it might not capture the highest returns during bull markets, low volatility investing aims to provide a smoother performance over the long run. So here are the key concepts of low volatility investing. Number one is volatility. Volatility refers to the degree of variation in the price of an asset over time. Higher volatility means that the asset price, is swinging widely, while low volatility means the price remains relatively stable. So low volatility investing targets assets with smaller, more predictable price movements. Number two is risk-adjusted returns. Risk-adjusted returns. Low volatility strategies, seek to optimize returns relative to the amount of risk taking. The focus is on achieving a favorable balance between return and risk, often measured by metrics like the Sharpe ratio, which compares the returns of an investment to the risk undertaken to obtain that level of returns. Number three is defense sectors or defensive sectors. So low volatility investing often involve focusing on defensive sectors such as utilities, healthcare and consumer staples. These sectors tend to perform steadily regardless of economic conditions because they offer essential goods and services that people will still need in both good and bad times, in both good and difficult times. Number four is low volatility index funds and ETFs. Low volatility index funds and ETFs. So investors can easily implement a low volatility strategy by investing in index funds or ETFs that track low volatility indexes. These funds are designed to include stocks with historically lower volatility, offering a diversified portfolio that aligns with the low volatility approach. Number five is behavioral finance. Behavioral finance. The low volatility anomaly, is a concept on behavioral finance where low risk stocks, tends to outperform higher risk stocks over the long term. So despite traditional finance theory, we suggest that higher risk should then correlate with higher return. It's not always so. Higher risk doesn't always translate to higher returns. So you should be able to achieve a higher returns at a lower risk. That's the essence of this low volatility investing. So what are the strategies involved in this type of strategy? Number one is stock selection. And investors may select individual stocks that have historically shown low volatility, stable earnings and consistent dividend payout. These stocks often belong to established companies with strong balance sheets and predictable cash flow. They have very strong fundamentals, and the cash flow they produce is relatively predictable. Number two is diversification. To further reduce risk, low volatility investors diversify across multiple sectors, regions, and asset classes. This diversification helps mitigate the impact of any single asset price fluctuation on the overall portfolio. Number two is a tactical adjustment. Tactical adjustment. So some low volatility strategies involve making tactical adjustments based on the market conditions. For example, increasing exposure to low volatility assets during periods of market uncertainty or potential downturn. So this approach has its benefits as well as its pitfalls. I want to look at the advantages and challenges of low volatility investing. Advantages here, we consider reduced drawdown. So low volatility investing help protect against significant losses during market downturns, leading to smoother portfolio performance. You equally have stable returns. This strategy often provides more consistent returns, appealing to conservative investors who prioritize capital appreciation. That stable returns is there. You equally have a behavioral edge. Number three is behavioral edge. The low volatility anomaly allows investors to potentially achieve higher risk adjustment returns over the long term. Is that you know returns that kind of risk adjusted? In other words, you have a higher returns at a lower risk. The challenges here include underperformance in bull markets. During strong bull markets, low volatility investments may underperform more volatile high growth stocks, potentially leading to a lower overall returns. Equally have limited upside potential. The focus on stability means lower volatility investments, might miss out on the higher potential gains from more aggressive, growth strategies. You could lose out of the gains that, growth strategies, could obtain. Number three is sector concentration. Because low volatility stocks are often concentrated in defense sectors, the strategy might lack exposure to other sectors that perform well in different market conditions. So you are like kind of limited, when it comes to sector exposure. So who is it for? Actually, low volatility investing is ideal for risk-averse investors who prioritize capital appreciation, capital preservation, and stable returns over maximizing gains or profits. It's also suitable for those nearing retirement or with a low tolerance for market fluctuations, and it provides a smoother investment experience, with reduced risk. It's good for retirees and it's good for people who don't like, who cannot really bear risk, high risk that is inherent in the markets. So these all about low volatility investing.